Welcome to the Deep Dive. We're your shortcut to, well, cutting through the noise and really getting a handle on complex systems.
That's right.
And today, we are jumping headfirst into the pretty fascinating, sometimes really confusing world of market trading. We want to decode some of its hidden mechanics.
It's a deep topic.
It is. Our mission today is to demystify what are known as smart money concepts. We're drawing specifically from some really powerful insights found in Decoding the Algorithm, ICT's Smart Money Insights.
Yeah, some potent stuff in there.
Definitely. This isn't about guesswork, or just reacting. It's about shifting how you see things, trying to understand the underlying script that drives price.
Getting behind the curtain, so to speak.
Exactly. Giving you a direct path to being well-informed on something that honestly can feel pretty overwhelming otherwise.
For sure.
And we'll be referencing this interesting session, kind of a teacher and student dynamic, where they unpack these exact ideas.
Right. It provides a good framework.
So let's start this deep dive.
Let's do it.
Okay. So our journey kicks off with an insight from the teacher in the source material that, well, it might just challenge what you think you know about market entries. It's a statement that, first time you hear it, sounds completely backwards. The teacher tells the student, and this is a direct quote, "We look to enter longs where retail sells. We look to enter shorts where retail buys."
Wow. Okay. Yeah, that immediately flips the script.
Right. And the student's reaction in the source was exactly that. Like, this sounds incredibly counterintuitive. And I bet a lot of you listening are probably thinking the same thing.
Absolutely. It goes against that sort of herd mentality instinct, doesn't it?
It does. Why would you deliberately trade against what seems like the crowd's wisdom?
Well, what's really fascinating here, and this is key, is that it isn't just about being contrarian, for the sake of it.
Okay.
It's about understanding the market's underlying mechanics. The teacher really elaborates on this, explaining that, and again, quoting here, smart money traders anticipate price-seeking opposing liquidity.
Opposing liquidity. Okay, let's break that down a bit.
Right. So smart money concepts. Fundamentally, they're these advanced strategies focused on spotting the footprints of the big players, institutional traders, the smart money. The goal is to figure out their real intentions and maybe even leverage the liquidity they create. Now, this opposing liquidity, it often means those clusters of stop losses from retail traders or pending orders that build up at really obvious highs and lows.
Oh, okay. The spots everyone sees.
Exactly. And those are precisely the areas that the big institutions needing to fill huge orders will actually target. They aren't following the crowd.
They're using the crowd.
Precisely. They use that predictable crowd behavior to their advantage. So you're not just going against the flow blindly. You're learning to anticipate where it's really going to flow next.
Which is often towards those liquidity pools.
Exactly, towards those pools. It really forces you to retrain those gut feelings, those initial, often emotional trading instincts.
That definitely reframes it. It's moving from just reacting emotionally to thinking strategically, anticipating.
Yeah, big shift.
So, building on that idea, the teacher then made a pretty bold claim about the market's very nature. They asserted this. There's an algorithm that delivers efficient market delivery.
Okay, an algorithm. That sounds complex.
Right. And the student, just like probably many of us, immediately voiced that concern.
Yeah.
Doesn't that make the market incredibly complicated? Almost impossible for a regular retail trader to really get or navigate?
It's a really valid question, a natural one, but the teacher offers this powerful reassurance. They said, it's simpler than you think when you have the right lens. The beauty is in its consistency.
Consistency, okay.
That consistency is absolutely key. You need to think of this algorithm maybe not as like a single piece of software you can just download,
right,
but more as the inherent programmed logic of how interbank price delivery works. It's essentially the market's fundamental operating system. And it's designed to efficiently match buyers and sellers. How? By moving price to areas of liquidity. It's just efficient engineering in a sense.
So the student then asked, logically, well, if everyone learns about this algorithm, doesn't it just stop working? Won't it become ineffective?
Critical question. And the teacher's response was very direct, very unambiguous. They said, the algorithms are not going to change because ICT is teaching you how to navigate with them. Period.
Period. Wow.
Yeah. And this really highlights a core idea. Human nature, and therefore how retail traders tend to behave, that's a constant.
People react predictably under pressure.
Pretty much. And the algorithm, it doesn't really care about how many people know about it. Its prime directive, if you like, is liquidity-driven efficiency.
It just needs fuel.
It just needs fuel. It's a fundamental system, not something that adapts because people are talking about it on Twitter. It will always seek liquidity no matter who knows.
Okay, so we're talking about understanding this fundamental unchanging market OS. If that's true, what specific signals, can we actually look for that might reveal this underlying logic at work?
Good question.
The teacher introduced a very specific concept to the student called SMT divergence, and they gave an example where NASDAQ fails to make a higher high versus a higher high formed on S&P.
Ah, yes, SMT divergence, a classic ICT concept.
So the student naturally wanted to know, okay, if I see this pattern, does that guarantee a reversal? Which is, the million-dollar question every trader asks.
Of course. And it's crucial to remember, the teacher makes very clear, nothing, absolutely nothing in trading is ever truly guaranteed.
Right. No silver bullets.
No silver bullets.
Yeah.
But these are presented as high probability insights. And what's particularly revealing about SMT divergence is what it implies. The teacher said, the markets are not random, they are purposeful.
Purposeful, okay.
So this specific divergence, seeing this difference between two usually highly correlated things like NASDAQ and S&P, it's not just a random blip.
It means something specific.
It suggests a subtle disagreement, maybe a lack of institutional conviction, or perhaps a distribution phase starting in one asset while the other still looks strong.
So smart money isn't confirming the move everywhere.
Exactly. It hints that maybe the big players aren't fully behind the prior move in one of those assets, which could signal a broader market shift, a reversal, or at least a pullback.
So it's about finding those specific, purposeful footprints in the charts.
That's it. Instead of just reacting to the general price noise, it's like spotting, a key piece of the puzzle that maybe most other people haven't noticed yet.
This idea of purposeful movement, it brings us to maybe one of the most provocative claims the teacher makes.
Uh-oh.
Yeah, it's a statement that, honestly, for many people, it might sound a bit like a conspiracy theory. The teacher states, quite bluntly, these markets are absolutely 100% scripted and controlled by an algorithm.
Wow. Okay, scripted and controlled, that's strong language.
Very strong. And the students' reaction really captured that initial skepticism. They asked, basically, what's the very first step to even begin accepting this reality when it sounds so well-controlled, so predetermined?
Yeah, I can see why that would be the reaction. It challenges the idea of a free, open market in some ways.
It does.
But this point is actually fundamental. If we link it back to the bigger picture, accepting this, let's call it scripted reality, is kind of essential if you want to truly leverage these concepts.
You have to believe the premise to use the tool.
Pretty much. And the teacher's direct challenge to the student, and really to all of us listening, is quite clear. They said, your first step is to open your eyes to the evidence in the charts. Once you see it, you can't unsee it.
The evidence is there, just need the right lens.
That's the implication. The patterns, the reactions, the price movements, they aren't chaotic or random. They follow a predictable logical sequence governed by this underlying algorithm.
So it's not about a specific group pulling strings necessarily.
No, it's more about recognizing that the market's fundamental behavior is programmed. Seeing that evidence yourself, how price reacts consistently at certain levels, how liquidity is targeted again and again, that's what's crucial for shifting your mindset.
For starting to understand the market on that deeper strategic level.
Exactly. You can't leverage it if you don't first see it and accept it.
That's a powerful challenge, the idea that the evidence is right there if you just learn how to look.
Mm-hmm.
Which leads us perfectly to what the teacher emphasized as, and these are their words, the most critical component of this whole approach.
Okay, the most critical part, what is it?
They posed this crucial question to the student. Knowing where the market's going to draw to, that's the most important critical thing, because all of these gaps, all these concepts, these smart money concepts, they're not going to help you unless you still can read where price is going to go.
Right. So all the tools are useless without direction.
Exactly. You need to know the destination. And the student then asked the question we all want answered. How do I actually develop that reading ability?
Mm-hmm.
That feels like the ultimate skill for a trader.
It really does. And what's interesting here is that the teacher's answer, it reinforces that this isn't some simple trick. It's a skill you develop through deeper study.
No magic formula.
No, they said. That's where the deeper study comes in. It's not about just memorizing patterns or using simple indicators. It's about truly understanding the market's intent. Where does its internal logic dictate price needs to go.
Okay.
The core idea, again, is that the algorithm isn't random. It respects specific levels on the chart. Price movements are purposeful. They're often driven to clear out liquidity or rebalance order flow at very precise points.
So developing that reading ability.
It comes from diligently studying those specific levels, understanding how the algorithm interacts with them. That allows you to anticipate where the liquidity pools are and where price is likely going to be drawn next. It's kind of like following a treasure map once you learn how to read it.
Okay, let's unpack this idea a bit more, the algorithm respecting specific levels. The teachers specifically mention tools they provide, stating, "The arrays that I'm teaching you, the algorithm will respect. My orders will be behind that."
Ah, the PD arrays, yes.
Right. So for listeners who might be new to ICT's terms, what exactly are these arrays and how does the algorithm respect them?
Good question. So when the teacher talks about arrays, they mean price delivery arrays, or PD arrays for short.
Okay.
You can think of these as like specific, almost predetermined price zones or levels on your chart. They're like a digital roadmap derived from past price action.
Right, based on history.
Exactly. And they act kind of like magnets, showing where the market algorithm is likely headed next, maybe to balance out orders or clear specific liquidity pools.
And the respect part.
The algorithm respects them in the sense that price consistently reacts at or moves towards these areas for precise, non-random reasons.
Got it. Which brings us to the student's immediate follow-up, which I'm sure many are thinking. Does this mean my stops are always safe if the algorithm respects these levels?
The eternal question of safe stops.
Right.
The teacher gives a really nuanced but vital answer here. They said, there's always risk, but you're treating with an informed edge.
Okay, so not guaranteed safety.
Definitely not. It emphasizes that even though you're aligning with the market's underlying algorithmic path, understanding its likely moves, no trade is ever truly risk-free.
Of course.
But by understanding how the algorithm interacts with these price delivery arrays, you're not just guessing anymore. You're operating with a much more informed grasp of price behavior.
Which allows for potentially better entries, exits, and risk management.
Exactly. It's all about stacking the probabilities in your favor, using that informed edge.
An informed edge, not an invitation to be reckless. Makes sense.
Mm-hmm.
And building on that, the teacher makes another really profound claim, saying, they're scripted, folks. They're absolutely scripted. And when you understand the source code, you can read them just like a book.
Reading the market like a book. That's the dream, isn't it?
That really sounds like the ultimate level of mastery for any trader. And the student, quite understandably, wanted to know, okay, what's the fastest way to gain this kind of source code understanding? Is there a shortcut to reading the market's deepest secrets?
Yeah, everyone wants the shortcut, right?
Always.
But if we connect this back, the source code, it isn't some simple trick or a secret document you can just find.
Right.
The teacher directly tackles that desire for speed. They said, there are no shortcuts to mastery. It requires diligent study and application, but the payoff is immense.
Diligent study and application. No quick fixes.
Exactly. This source code, it refers to that underlying predictable logic of how the algorithm delivers price. The consistent patterns, its precise reactions to liquidity, those specific PD arrays it respects.
It's the market's internal language.
That's a great way to put it. It's the market's internal language, and you learn it through careful observation and really understanding the concepts.
So how do you learn it?
It requires consistent effort, studying the concepts, meticulously applying them to the charts day in, day out. It's a journey of deep learning, pattern recognition, and just continuous practice. The payoff isn't necessarily instant riches, but it's that profound understanding. It lets you approach the market with confidence and foresight, like you're reading a story unfolding rather than just watching random noise.
That's a powerful reminder. True mastery, even with incredible insights, always requires dedication.
Always.
And finally, the teacher leaves us with a really impactful insight, kind of revealing their whole approach. They said, I teach you how large institutions and fund managers view the marketplace so that way you can see how the algorithm cannibalizes them.
Cannibalizes them? Whoa, that is a striking phrase.
Isn't it? And the student's reaction was pretty strong, too, asking, well, how do you avoid that fate? How do you avoid being cannibalized and instead learn to think and operate like those big institutions?
It's a visceral image. And what's really fascinating here is the teacher's ultimate advice. It's not just about trading patterns anymore.
It goes deeper.
Much deeper. It's about understanding the market's deep psychology and its mechanics. How? By learning what these large institutions do, when they do it, and critically, why they do it.
Understanding their game.
Exactly. By embracing that algorithmic reality of price delivery, you stop just trading simple patterns. You start engaging with the market's actual intelligence.
So what does that mean practically?
It means understanding their inherent need for liquidity, knowing their typical entry and exit points, and crucially, seeing how the algorithm often exploits common, predictable institutional behaviors.
Ah, so their own patterns can be used against them by the algorithm.
Precisely. And that creates opportunities for those who understand the script, as the teacher calls it. By learning to see the market through their lens, the institutional lens, you position yourself differently.
Not as a target.
Not as a target, but as someone who understands the deeper game being played. That allows you to navigate with, well, far greater insight and precision. It's about becoming an active participant in the market's real intelligence.
And that really wraps up our deep dive into decoding the algorithm, ICT's smart money insights.
Wow.
Quite a journey through those concepts.
It really was. Today, we've peeled back some serious layers of market mechanics, haven't we? Explored how institutions might trade against the retail crowd.
That counterintuitive start.
Right, and the market's underlying algorithmic nature, its predictable responses to liquidity. We touched on specific signals like SMT divergence.
And the importance of those price delivery arrays.
Exactly, how understanding those arrays can potentially unlock the market's true intent. We've gone from recognizing the market maybe isn't random, but scripted. That core, challenging idea.
To the really profound realization that by learning its language, its source code, you might be able to align your own understanding, your approach, with its true intelligence.
So here's a final thought maybe for you to ponder. If the market truly is as scripted and, purposefully driven as these insights suggest, what does that really imply about a lot of the conventional wisdom out there about trading?
Yeah.
And maybe even more broadly, how does it reshape your personal approach to understanding any complex system that seems chaotic on the surface?
That is definitely something to chew on. A really interesting question to leave things with. Now, for more in-depth knowledge, and if you want to continue your own journey into mastering these ICT concepts, the source material points towards visiting gitchytrades.com/landing.
Right, for further resources.
Exactly. They mention you'll find comprehensive resources there to help empower your trading. We really hope you've gained some valuable insights from this deep dive today.
Hope it was useful.
And we'll look forward to exploring another complex topic with you next time.